Good evening, everybody. We are back. Welcome back to Endowus Live webinars. Today, we'll be presenting on the Endowus fourth quarter and 2021 full year market insights and performance review. Thank you so much for joining us. Happy New Year to all of you. I'm Sam Rhee. I'm the Chairman and Chief Investment Officer of Endowus. And today I'm joined by my colleague Yulin. Say hi.
Hi everyone. Hi, this is Yulin, and I am the investment lead at Endowus. I'm really happy to be here with all of you tonight.
Great. So we're going to jump in, guys, with the disclaimer and the Slido poll. So as usual, we'll have a Slido poll going. Sorry, it's not a poll, but questions. So please leave your questions. This is the event code. You can type it up. Or in your YouTube, there's a link right below in the description. So you can just click it and go straight to the Slido questions. Please leave your Q&A. We'll go through the whole slide today because there's a lot of content and material to cover. And once we're done, we'll leave the Q&A to the end. So, and apologies that we will not be able to track multiple sources. So we'll consolidate all the questions on Slido. So anything on YouTube or any of the other channels, we'll not be able to see. So we'll just respond to the Slido questions. So if you can go in there, you can also upvote or downvote questions. So we'll always choose the most popular questions out there. Okay, so we're going to jump right in with a review of the fourth quarter and 2021, which was a year where, the two biggest economies obviously dominated the headlines. With COVID, recoveries and then setbacks, we had a lot of volatility in the news flow. But the markets actually showed a very steady rebound. And actually performed quite well. We had a very strong quarter in the fourth quarter, despite some wobble initially. But as you can see, what's interesting is that while developed markets and global equity returns did relatively well, emerging markets actually did not do so well, driven by many emerging markets' concerns about inflation, especially concerns on some systemic risk in China as well. If you look at the green and orange dotted lines, which are the bond index, it's clearly shows that, while it's had a stable and decent return in the first half, second half was especially challenging into the end of last year. Where did the equity market returns come from? If you look at the globally diversified portfolio that we have for our core portfolios, a lot of it was driven by the US again. So it had a strong finish to the year. And Europe actually rebounded quite well and outperformed, whereas the underperformers were Asia and the emerging markets, which suffered in returns last year. If you look at the broad market returns between DM, EM, obviously DM did better, US did better. Among the sectors, the growth sectors like technology, which performed really well throughout the year, and then in Q4 had another bumper rebound after a bit of a stall in the third quarter. But also we had guys like basic materials, commodities, performing very well in the fourth quarter. And across the board, I think we saw very strong performance across sectors. So even energy, which was a bottom three performer in the fourth quarter, actually did tremendously well and was the best performing sector for the full year. And then obviously within fixed income, it was a challenging year across the board for core bonds and global fixed income, and including governments, which suffered from the rising yields towards the end of the year, but high yield held their ground and did relatively well. But after suffering in the third quarter, Q4 actually was not a bad quarter. Within equities, the big debate was, is value coming back? But fourth quarter growth actually did tremendously well. And despite that, I think 2021, you can see that growth and value actually in the large cap space did relatively well. But value did across the whole market cap space. So large, middle, and also small outperformed significantly for the full year. And that is after, a strong performance in the first half, and it continued into the fourth quarter. So fourth quarter results were quite favorable for value. If you look at the 3-year track record, value has made up a lot of time. It underperformed significantly against growth for much of the decade, but has really started to outperform in the past 1 to 2 years. Yulin.
Yeah, thank you, Sam. Thank you, Sam. So let's just take a quick look at the broad fixed income market. And so over the long term, for the past decade or even 2 decades, actually, the real yields have been getting lower and lower, making it a very good environment for bond investors. But towards the end of this year, we are actually seeing that reversing a little bit. Driven by the continued concern on, elevated inflation and the fresh expectation of faster Fed tapering and rate hikes, the real rate started to edge higher, at least in the US and Europe, towards the end of the quarter. And moving on, so this chart shows the overall performance of the different key markets in fixed income. And generally, it was a negative year for global bonds as investors grapple with the implications of economic rebound, the emergence of new variants, inflation concerns, and Fed policy in response to it. And credit in particular, US credit actually fared pretty well, and it's the best performing sector in this environment. Whereas on the other side of the world, Asia credit it suffered quite a lot, especially dragged down by the Asian high yield sector. And as we know, more than 50% of this actually consists of Chinese property names. And we can see this from the orange line trending downward towards the latter half of the year. And the next slide, thank you, Sam. It breaks down the fixed income market return into detailed segments, and consistent with what we saw, high yield sectors contributed positively, as well as inflation-linked bond sector, whereas the treasury market as well as global investment grade market did less well for the year of 2021. Now let's move on to the overall quarterly performance review of our portfolios. And this chart just shows quickly the 5-year performance of the core Endowus portfolios versus the asset class benchmarks. And that's MSCI All Country World for equities and Bloomberg Barclays Global Aggregate Index for fixed income. So we have 2 different core portfolios, our flagship portfolio and ESG. And our flagship portfolio is available for all sources of wealth, including cash, CPF, and SRS. And ESG is available for both cash and SRS. And all our portfolios are constructed using long-term strategic asset allocation and are very globally diversified, which means that we don't try to tactically time the market and make tactical calls based on market conditions. So its long-term performance should be in line with the broad market, and this is exactly what each of the portfolio have done over the longer term. And now let's move on to look into the flagship cash and SRS portfolio. So for the 4th quarter in 2021, the portfolio the equity part of the portfolio bounced back very favorably from a muted decline in the 3rd quarter, and it actually generated 5.9% of performance for the 4th quarter and outperforming the MSCI Equity Index. So the equity portfolio ended it very well with 22.3% performance compared to a 20.9% performance of the benchmark. And on the fixed income side, we ended the quarter with a minor negative 0.3 pullback. And overall for the full year, actually, the core flagship fixed income portfolio did outperform the global fixed income market that actually went down by almost 1.3%. And the next slide breaks down the outperformance of our portfolio. So for those who are familiar with our portfolio, you will know that our flagship cash and SRS equity portfolio is extremely diversified, and it has tilts towards proven factors of return, such as size, value, and profitability. So it gains broad exposure to the market with over 10,000 stocks in the equity portfolio, but it hasn't emphasized on smaller companies, cheaper companies, and more profitable companies. And such tilts have actually paid off and contributed to our outperformance in 2021. So you can see that in the developed markets, the small value companies outperformed the large growth by 2.3%, and the small and high profitability companies outperformed the opposite, the large and low profitability companies by 1.2%. And let's move on to look at emerging markets. On the next slide, where actually the outperformance is much more pronounced. So actually, for the whole year, the small value companies in emerging markets outperformed large growth companies by 16.4%. And the small and profitable companies outperform large and less profitable companies by 11%. Now let's move on to look at our flagship CPF portfolios. So similar to our cash and SRS portfolio, our flagship portfolio finished Q4 with a solid rebound in equities, recording a 5.4% positive performance. And also similar to the cash and SRS portfolio, the fixed income portfolio put back slightly, delivering a negative 0.2%, still better than, still in line with the benchmark. So the flagship portfolio wrapped up 2021 quite well, with 4 out of 6 of its allocations outperforming the CPF 08 interest rate of 2.5%. And one thing to notice that the construction is inherently limited by a lack of access to better solutions on the CPFIS included funds, in particular on the fixed income side. And on the equity side, actually, we have brought into the to infinity passive global and US equity funds to improve access to more passive and lower cost funds, and therefore improving the efficiency and allocation of the equity portfolio. But overall, although the fixed income portfolio was dragged down by the Q1 losses due to inflation concern, the remaining quarters did make up and help to mitigate the initial loss quite well. And finally, let's take a look at the core ESG portfolio. So we launched the core ESG portfolio in the first quarter, towards the end of the first quarter of 2021. And this is the first multi-asset and target risk ESG portfolios that has been made available for the Singapore retail investors for both cash and SRS. So this has continued to deliver really great returns. It was the most defensive in the third quarter. When the market was down, it actually was up by 2.3%. And this quarter, it continued to deliver positive performance of 4.3% on the equity side. And overall, the whole year for the equity market for this ESG portfolio, although in the first 2 quarters, there were slight headwinds due to the rally in traditional energy names, which is a sector that this portfolio holds less because of its sustainable tilts. But the latter half of the year, it really outperformed the equity market quite strongly, making up for the first half of underperformance. And it ended the year in line with the benchmark, just like what we have always designed this portfolio to be. And on the fixed income side, actually it's the best performing portfolio amongst the 3. It's the most defensive. It's only down by down by 0.3% compared to a negative 1.3% global bond performance. Yeah. So this testifies to how investing in companies with sustainable business practices, it does not necessitate sacrificing return. And with this, let me hand over to Sam to touch upon our Cashsmart portfolio performance.
Thanks, Yulin. And, really impressed with the ESG portfolio performance. It's definitely in a volatile year like this, it's been a low vol kind of strategy, especially for fixed income and equity. So if you look at the 60-40 balance portfolio, which a lot of our clients choose for ESG, because they want an exposure to not only the equities, great ESG sustainable companies, but also green bonds and green projects financing, really quality sustainable projects. It's actually exactly in line with the global 60-40 index with an 11.6% return. So it's been a phenomenal lower volatility and higher Sharpe ratio strategy. So would really recommend investors to at least have some allocation to ESG in their core portfolios. Now I'm going to jump into Cashsmart, which has been a bit of a noisy product for us recently because of the overall kind of shock that the fixed income market has seen. And it has impacted not only the core fixed income markets and Asian high yield, like Yulin highlighted earlier, but it also impacted the short duration part of the fixed income market, which led to some negative returns in the fourth quarter for Cashsmart solutions, or two of them at least, because Cashsmart Core, which is now renamed Secure, so we need to update this, sorry. Cashsmart Secure actually generated a positive return, a steady positive return throughout the year, to end the year at a positive 0.78%. But Enhanced and Ultra actually had a difficult fourth quarter, especially in September, and then again in up to November, with a rebound in December. So we just published a detailed note on Cashsmart that I would recommend all Cashsmart clients to have a look at. It goes into details of addressing all of the key client questions that have been raised with us. We've tried to be as transparent as possible in giving you as much information to make an informed decision. But just to clarify that there is a reason why we have 3 Cashsmart products. It is dependent on the risk that each of these portfolios inherently have. So Cashsmart Secure is the stable, safer bet, and it is able to generate good returns, as we saw. 0.8% is significantly higher than anything you can get, even fixed deposits that you keep for 12 months. And this has generated consistently 1.38% last year and 0.78% this year. Enhanced and Ultra last year, for example, gave us tremendous returns. In the first half, the returns were great, and many people were happy. But as we came into the fourth quarter, this correction has been painful, especially for clients that have used it for relatively short cash holdings, and they need the money. So I think that we wanted to once again highlight that this trade-off between risk and return is always there. As the chart shows, Secure has lowest volatility, virtually none, whereas Enhanced has some volatility, and Ultra is by definition a fixed income product that we're using to diversify and reduce volatility so you can use. But it requires you to hold on for a longer period. And during risk on and risk off period, depending on the risk you're taking, Cashsmart Secure being the lowest risk, and then Enhanced, and then Ultra, and then we also have low volatility fixed income, which replaced the UDP portfolio, and the Flagship 100% fixed income. And you can see exactly how they're perfectly correlated. In down markets, the highest fixed income product falls the most, and the most secure product with the lowest risk obviously falls less. And as a result, when it goes up, the same thing, the reverse happens, and the safer ones obviously go up less. And you can add equities into this, and you'll see the same correlation. Equities will be seeing a much, much higher volatility. And this is with the chart, you can see that the light blue line of Secure, the blue line of Enhanced, the green line of Ultra, and then the low volatility fixed income of orange, and then the 100% fixed income of yellow. And although throughout this period, 100% fixed income did well, from the peak to trough, you can see that it fell 2.17%, much more than any of the other products. And then in the rebound, obviously, it does well too. So this correlation between risk and return is there. We gave you 3 products in Cashsmart, 2 additional 100% fixed income products, so that you can manage the risk, take the appropriate risk for you, and in an up market, obviously get higher returns. But you cannot have it both ways. If you want the returns, you need to take risk, which accompanies with it more volatility in order to achieve that return. And also, if you want to take less risk and less volatility, then you're going to have to settle with lower yield. So I think that each individual has a difference in their risk appetite and personal preference, and it's really important for us to really ascertain that. And same thing in March 2020, all of this moved in tandem. But what's really striking is how the Asian high yield underperformed massively this year, even more than it did in March 2020. So these are really unprecedented kind of dislocations that we're seeing, especially driven by Asia and China, and we'll go into that in a little bit more detail. And a reminder of what happened in March 2020 versus September 2021. The Cashsmart Ultra, for example, actually did fall less. It fell 1.3% versus the 2.6 that happened in March 2020. But the time that it's taking to go down and then rebound is much, much longer. So we have to understand that each cycle and each market is different, and we have to be cognizant of the risks of each cycle and how they're unique. But please check out the Cashsmart update, which has all of these charts and much, much more, giving you a lot more detail. And we'll please reach out to our client advisors if you have any specific questions. I'm going to move on to this table, which is we get asked a lot how we are doing compared to other robos or other products out there, and we don't like to compare too much, but this is something that Seedly, which is an open community, and one of the Seedly members actually always on a monthly basis posts his portfolio of the 300% equity highest risk strategy between Endowus and the two other players in the field. And you can clearly see that Endowus's portfolio has been much more stable and much more in line with the global market. So the MSCI All Country World Index is the global index. It's confusing because there's an MSCI World, but that's not global. That's a developed market index. And we have an emerging market index, Asia index, and the Singapore Stock Exchange STI. You compare that, and Endowus is the only portfolio that has tracked global indices and has generated a return compared to the others. And you can see this in this chart where, one player is largely tracking the Asia ex-Japan because of their large China and Asia exposure. The other one is tracking STI for some reason, but Endowus is doing exactly as we designed it, which is tracking the MSCI ACWI and generated passive strategic asset allocation returns that we would expect from this portfolio. So we're doing exactly what we say, and we're not a black box strategy. Our core flagship portfolios, whether it's SRS, CPF, or cash, or ESG, all of these are built to be globally diversified, low-cost solutions that will give you an opportunity to generate long-term returns. Okay, that's the performance segment, and we're going to move on to the outlook for 2020. So it's a very mixed outlook. Just a brief summary, the economic activities are trending good despite the Omicron variant and outbreaks. And even Singapore numbers are creeping up here. But generally, I think economic activity is recovering, especially on the demand side. There's still some issues with the supply side, especially with Omicron again and shutdown in China. And major production bottlenecks and shipping bottlenecks, cost and prices are rising, and therefore inflation is overshooting. And as a result, monetary policy, which was ultra easy and lax, is now starting to move towards the neutral, and that's the biggest topic that we will discuss today and exists in the market. But just a backdrop of where global growth is. You can see this is the World Bank's GDP growth forecast for 2022, 2023, and the updated one for 2021. And this is updated from 6 months ago, and they have revised down the numbers for 2021 and 22, and they've revised up the 2023 estimate slightly. But the numbers for 2022, one is obviously a very strong rebound from a low base. 2022 at just above 4% is actually above trend for global growth. So the numbers are not too bad. And it's driven by the US, which has generated slightly stronger and firm finish to the growth trajectory last year. And also even China, despite all the concerns. If you're purely looking at growth, the growth numbers actually did surprisingly well in 2021, obviously with a low base. And it was driven by consumption and net exports, which was surprising. The biggest topics, like Bank of America does a fund manager survey on a regular basis. This was the most recent one in January 2020 from last month. The big change is obviously COVID-19 resurgence, which was very dominant in the US and Europe. Obviously, that's fading as a concern because obviously Omicron seems like it's not going to impact us in a big way. And the biggest concern, and obviously the topic du jour that everyone's focused on, is the more hawkish central bank, especially the Fed, and that's driven by inflation. And therefore, it gives us concern whether there is a major asset bubble across various asset classes. So those are all related topics, and we'll go into that in more detail. Now, touching on inflation, because it is the backdrop and the reason why monetary authorities and central banks are tightening, where are we? Is the big question. And we are all still hitting record high numbers. And obviously, base effects will start to kick in. 2021 was a base effect rebound from 2020. But we'll see that inflation and prices are remaining stubbornly high. This is food. I'm looking at commodities here, soft commodities like palm oil, but also petroleum. So commodities in general have soared recently and have been at elevated levels. Shipping costs, which is a major factor in consumer goods and production of manufacturing, remains at elevated levels and is not showing any declines. Another major input and source of inflation, especially in the US, is labor cost. I think that the fiscal checks and also the lack of surplus labor has resulted in labor costs rising quite meaningfully and staying relatively higher than expected. And these kind of bottlenecks, especially on the supply side, is leading to cost push inflation, and it's being transferred into input costs and output prices, especially where they have pricing power. But the most important thing, if you put that all together, whether there's any signs that the supply chain constraints are being eased, it doesn't look like it at the moment. It's just off of the highs in December and remaining elevated. And every single component is showing signs of supply constraints still. So this is a cause for concern for us. And this is exactly why I think recently the Fed has become much more hawkish in its communication. I think the expectations now of a March rate hike is almost a certainty. The debate now is at 25 basis points or 50 basis points. And the market has shifted dramatically from last month when people were expecting one, most likely two. And so 2 rate hikes this year. And then the next highest was 1, not 3 rate hikes, as opposed to now, everybody's expecting 3 rate hikes. And actually, more recently, people have been gravitating towards 4 rate hikes rather than 2. So it's a very rapidly changing landscape. And the Fed is going to accelerate the tapering, raise interest rates, and then also reduce balance sheets much faster than people expected. And if we see where we will end up, they expect another a hike in March, and then another one in March. So every quarter we'll see a hike. And many people now expect December to be another hike. So every quarter we'll see a hike and 4 hikes above 1%. The markets have actually already started pricing that in. The 10-year US Treasuries have moved, as you can see on the right, spiked up to closing in on 2% already. So they're pricing that in. But what's interesting is that the yield curve is flattened, that the long and the short end have both risen, and the yield curve has flattened, which is raising concerns about the growth expectations as well. Now, this is really a chart that basically puts together all of the things that I mentioned earlier. But the reason I put it here is because you can see what happened to the FOMC, Fed fund rates in 2017 and 18. That was the previous cycle when the Fed started tapering, reducing the balance sheet, and then increasing interest rates finally. And the increase was gradual, but it was a steady increase as inflation improved. And unemployment, because the Fed has a dual mandate, unlike many central banks, of targeting not just inflation, but also employment in the US. They continued to raise rates until the end of 2018, when it reached 2.5%. And the market rates rose to 3%. So the market again moved ahead, and the long end of the treasuries moved to 3%. And that was a year that until 2018, the market was actually quite positive about the economic recovery. They brushed off the Fed funds rate increase. And it wasn't until 2018 when they continued to break beyond that 2% threshold to get to 2.5, and market yields past 2.5 to reach 3%, the market got spooked. And the Fed obviously was actually expecting to hike rates further in 2019. But obviously COVID hit, and that was something that changed dramatically overnight. So it's interesting to note that the equities market did not do so bad in 2017. And it wasn't until the second half of 2018 when Fed fund rates broke through a threshold that we saw equity markets becoming a bit wobbly. With that, I'm going to hand over to Yulin.
Yeah, thank you, Sam, for this very, very comprehensive overview of the current macroeconomic environment that we are in. And I think it does resonate with a lot of investors, as you know, it sounds like that there is a lot of uncertainty still hanging. And this raises a lot of questions, and one of which is, how do we do asset allocation in this environment? What should we think about, asset class returns and how they behave? So this is a very difficult question, I have to say. But granted, it's a very important question. So one thing we can do is to go back to look at some historical data and see how that could shed light to us in the present moment. And this chart, this chart presents a stylistic, it presents stylistically how different asset classes are geared towards two very important indicator of the economy, that's inflation and growth. So how they move in tandem with inflation and growth. And we can see that generally the riskier assets like equities, commodities, and EMFX, they tend to move together with GDP growth. So when GDP growth is positive, they tend to, on average, move in the same positive direction. However, within those asset classes, some are more linked to inflation, to inflationary pressure. So, for example, commodities and natural resources equities and even MLPs, which are mostly just natural resources and actually real estate companies. And this makes intuitive sense, right? Because energy price, commodity price is a very important component of inflation index anyway. So when inflation goes up, those types of companies benefit from higher inflation as well. Whereas on the other side of the spectrum, when the economy is probably in the contracting, then actually those safer assets such as fixed income and gold and inflation-linked bonds, they tend to benefit from that. And but then there is also a divide between high inflation and low inflation, and actually gold and inflation-linked bonds, they tend to move in positive direction together with inflation. Whereas for fixed income, if it is in the low inflation and low growth environment, it might not do that well. So moving on to the next slide, we take a closer look at equities in more details. So of course, the direction of inflation matters, but the magnitude also matters. And we see that generally, actually, when inflation is generally low, so below 3%, most of the time. So this chart is the rolling 12, the percentage of the 1 year rolling performance of the equity performance, the percentage of the time that it has outperformed the inflation rate. So in a low inflation environment, actually most of the time equities have outperformed inflation, whether the inflation is rising or falling. But the real divergence comes when inflation is high, that is, it's above 3%. And equities still do quite well. It still did quite well when inflation is high, but it's falling. But if the inflation is high and it's still rising, then it's the least favorable environment for equities. And investing in equities, hoping to outperform inflation in this environment, is no better than tossing a coin. And however, if we move on to the next slide, even in the so we have seen that high and rising inflation is negative for equities market, but historically there are different sectors that even in this environment have more consistently delivered outperformance to inflation. So this chart looks a bit daunting in the beginning, but actually let me just explain and break it down a bit for you. Basically it measures how consistently, that's the x-axis, the equity sector has outperformed inflation in the past from 1973 to 2020. And on the y-axis, it shows the average performance of the sector in the high inflationary environment, high and rising inflation environment over the same period. So that means if we look at the top right, for energy sector and even REIT sector, as well as consumer staples, they have been more consistently actually delivering higher performance than inflation during this generally negative environment for the overall equity sector. Whereas on the other side of the spectrum, we see that technology names, IT sector, and consumer discretionary sectors, and even mortgage REITs, those are the companies that don't really hold the real property, but they lend out. So when inflation is high and rising, they actually get hit. And it makes sense because they are, for example, for tech companies, their cash flow is far in the future. And when inflation is high, it means that the discount rate that the investors put on these future cash flow gets higher, which would suppress its cash flow, its valuation currently. So let's move on, and this chart shows actually how the equity market has historically reacted to the Fed rate hike. And this is very important because I think the direction of travel of both inflation and growth actually largely hinders on how well the Fed can execute this tightening cycle. So the question is, can the Fed actually finish the cycle without slowing down the economy too much or without triggering disorder in the financial market? So this chart probably provides us with some comfort because historically, actually, from 1950s to now, there have been 12 hiking cycles, and out of the 12 hiking cycles, 11 of them, during 11 of the cycles, on average, the US equities market have recorded positive performance. And the only exception was in the highly inflationary and recessionary environment from 1972 to 1974. Yeah, thank you. And so moving on to this chart, again, it studies the 2-year correlation between the monthly stock return and the 10-year treasury yield. So I think this chart does shed light and kind of correspond to what Sam mentioned earlier, which is we see that the relationship between equity market return and interest rate starts to get definitively negative after the interest rate reaches a threshold. And this threshold was about 4.5% before the global financial crisis, and it dropped to about 3.6% after the global financial crisis. But of course, granted, we see that we don't really have a lot of data points. And after global financial crisis, there were only about 2 to 3 times, one of which was the 2018 period, that actually the US 10-year treasury yield have passed this threshold. And before this threshold was reached, there is a quite large dispersion of this correlation, but they are mostly positive. They're mostly in the positive realm. But we do see that as the yields get higher, the positive relationship between stock return and interest rate, they do weaken, which actually shows that apart from interest rate, there are a lot more factors that could possibly affect the performance of equities market. So we are not close to that threshold yet. We are, about 2%, and we'll probably get a bit higher later. So it is good to still be cautiously optimistic about equities, and at the same time try to understand other factors at play that would affect equities return rather than being too fixated on the interest rate. Yeah, and lastly, before we move on to a slightly different topic, this is just more of an interesting data point for us to see. and these shows the performance of different equity sectors historically, before 3 months before the Fed rate hike and 3 months after the Fed rate hike. And generally, actually, we see that before the rate hike, actually the equities market recorded positive performance, but then there was a large swing, bringing it to the negative realm after the rate hikes. And there were some sectors that actually delivered pretty good outperformance, like materials, industrials, and even technology before the rate hikes. But again, this was followed by negative performance afterwards. So it's interesting to see, but just to caveat that this data only consists of 4 rate hikes. So it's more of a reference point for us to compare with the current environment rather than guiding any of the decisions to invest. And with this, let me hand over back to Sam to talk about US equities valuation and other more interesting things.
Thank you, Lynn. So one of the other headwinds that I think, apart from inflation and the interest rate cycle, is obviously valuations, especially in the US, which represent, more than 60, 70% of the global indexes. That US equity valuation, despite coming off slightly, has remained relatively high. Now, price earnings, especially, is just one of the many valuations that you would look at. But it's the most common. And so forward PE obviously affected not only by price, which if it comes down, PE gets corrected, but if earnings grows faster, then obviously that comes down too. And that's why with earnings strong recovery in 2021, PE has come down, but it's still at 1 standard deviation above historical averages. And if you look at the CAPE, which is the cyclically adjusted average, then it's even higher. The other negative, I think, for the market is that there is a high level of concentration. This is something that we've talked about in the past, that the top companies seem to represent a much higher part of the growth, which means that the risk is concentrated as well. That if 1 or 2 or 3 companies falter, then all of the market does poorly. It's much better if there was a broad based recovery. And so I think that there's opportunity here as well as risk, that even if the top companies don't continue to deliver in terms of performance, then as the market broadens out and the economy broadens out, there will be opportunities for us to look at other areas that will do well. And that's why earnings is so critically important, that the earnings for this year, consensus numbers have come off slightly recently. But generally, if it remains strong, then it will be a support for the equity markets. Right now we are revaluing the market because of the sudden expectation that interest rates will be higher, and interest rates are it's so critically important for valuation, because equities in the end is the present value of future cash flow. And in order to calculate the present value of future cash flow, we need to use a discount rate. And that is the interest rate that we use, or the risk-free rate, or whatever people prefer to use. But that's the interest rate sensitivity of the equity market, that all future cash flow has to be discounted. And if interest rates are higher, then that discounts any future earnings high from current levels. Because of higher inflation, the $100 that you earn now is not the equivalent of $100, many years from now. And that's why I think it's really important for us to focus on and know where interest rates are headed, because I think it does, affect valuations of equity markets. But if you have strong earnings, that's a positive. Also, I think it's important to note that US has continued to be a stellar performer and have driven global equity market returns. But last year, China and emerging markets did poorly, and Europe came back quite strongly. But if you look at where earnings is going to come from, surprisingly, 2022, China numbers are not too bad, and then also Japan looks pretty good as well. So I think that valuations being much more much more like safer or lower versus the US in particular on the chart on the right, and closer to long-term historical averages for China and emerging markets or even Europe, suggests that there is an opportunity that valuation discount that we're seeing in US because of the interest rate cycle movement may not impact the rest of the world in such a big way. And in particular, China, which is moving against the tide and being counter-cyclical, as we say. Every other central bank is raising interest rates. Even its neighbor, Korea or Taiwan or everywhere, is raising interest rates. But China is actually cutting interest rates. So that counter-cyclical aspect of China could be an interesting thing to watch for us. And I think it's also important to put into context a correction. So I see, we're trying to answer some of the questions as we go along on Slido. We're answering the question about, the Fed raising interest rates, how the market reacts, and the possibility that this reaction is different. So we're looking at all the different permutations. But there's also a question that, I don't know, Anonymous put up that I lost a lot of money in Flagship portfolios. Will it continue to go down or will it rebound? And I'm a bit perplexed. You must have put in a lot of money to have lost a lot of money in Flagship, because we track the performance every day, and year to date, the Flagship performance for cash is now down 3.6%, and for CPF is down less. It's minus 3.11% year to date, and we know we had a strong finish to the year last quarter. So you're only down 3-4%. Not only, it's painful and it's very sharp. So it happened very quickly. So it's painful, but you have to understand that the market correction of 5% or 10% is quite common. It's very normal for markets to have a drawdown, but these drawdowns are not the equivalent of annual returns. So just like March 2020, we saw a 30% correction intra-year. That was a pullback. It was a correction. Some people, because it's above 20%, would call it a bear market. But the full year return for 2020 was positive double digits. So, you have to understand that these pullbacks happen all the time, sometimes in a meaningful way. But look at what happens at the end of the year and the full year returns. It's much better than the worst outcome at any given point in time. And a 5% drawdown on the left here happens almost every single year. Last year was an anomaly. Last year was a year that is one of the 6% historically where we did not see a 5% or worse drawdown. And so most recent, experience teaches us, is like recency bias is very strong. So people think that, hey, that's normal, but it's very abnormal. A 5% correction should happen every single year. A 10% correction should happen more than half the time. And a 20% correction, which seems like a lot, would happen more than a quarter of the time. But what would happen is that markets will recover from that intra-year fall to post a better full-year return. And so we have to stay invested because we know that long-term returns will be good. And all-time high achieved last year was a record 70 times, 68 times to be precise, even beating the 2017 number. And 2017, remember, was a year that actually was a period when interest rates were rising. With that, we also want to focus on the growth stocks that are getting pummeled, especially tech stocks. It's natural, especially in an environment where interest rates are rising very quickly and inflation is going up. As I said, the most expensive sectors get affected the most when interest rates rise because we heavily discount future earnings. And a lot of technology companies don't even have earnings, so therefore we discount it even more. And that's the perception. It may not be true for all tech companies, but I think it's something that the first reaction that market and people have would be to sell down the high growth, the high valuation sector. And that may be an opportunity for us in the long term. It may continue to underperform other value sectors, but it's something that will play out throughout the year. And the one other thing that I would say is that it's not just technology. It could be healthcare, it could be megatrends, it could be other sectors that have been pumped up and overvalued. And these are two other, highly, popular recent trades that happened, which is the ARK Innovation and how it's massively underperformed and have fallen more than 50%. Somebody, I think Financial Times today published a chart showing how ARK went up so much and then came back down. And now it's performed exactly in line with Warren Buffett's Berkshire Hathaway, which has been a steady Eddie performer and a value biased investment. But also, it's important to understand, like Bitcoin and cryptocurrencies, one of the strong arguments to own cryptocurrency from an investment perspective and from an asset allocation perspective was the fact that it had low correlation, low historical correlation to traditional assets. And that has broken down. I commented on this earlier last year, that it seemed like correlations were rising as liquidity was what was driving a lot of these asset classes, and cryptocurrency, being a financial asset, increasingly showing higher correlation. And this again shows clearly that the correlation is very, very high. And so we have to understand how these correlations between asset classes change over time, and really, understand why we can't rely on historical numbers only, because the future may be different. The final thing is that between factors, I think two factors that really stand out is growth versus value, and how value is at an extremely undervalued. Obviously, value is undervalued, but value is at extreme levels of underperformance versus growth. And also quality is something that comes and rises, especially in periods of inflation and rising interest rates. And dividend stocks and equities is a good reflection of quality, sustainability of earnings, pricing power, and the ability to pay out that earnings without having to reinvest for growth. So dividends is, an interesting angle. And this is why it's important for us to have launched these income portfolios. So Endowus is launching soft launch to existing clients, and launching tomorrow our income portfolios officially to external clients. And Yulin and I will be back with another webinar in 2 days' time with the launch of the income portfolios. But this is part of why it's important for us to diversify and have some quality in our portfolio, because they have consistently outperformed, especially during inflationary periods. With that, I'll hand back to Yulin to wrap up.
Yeah, thanks, Sam. I think we will just wrap up our prepared remarks with some colors more on the fixed income market as rate increases, and how this would impact different parts of the fixed income market. And as we can see, actually, the direct relationship between rate and the return of a bond is that the rising interest rate would actually decrease the price of a bond. But actually, the total return of a bond consists of two components, and that is price as well as coupons. So in light of that, for the government bonds that actually pay quite low coupon, an increase in interest rate would have a overall larger effect, especially on the longer end of the government bonds. So the right-hand side of chart visualizes that for us. As we can see, a 1% increase in interest rate, a parallel shift in the yield curve would actually cause about 18% decline in the 30-year Treasury yield bond. And that sensitivity is measured by duration. So when you are investing in fixed income portfolios, duration is one of the key metrics that you probably should be aware of, and try to limit your exposure to duration if you think that the rate will continue to rise. Whereas on the corporate bond side, because the corporate bonds, they are paying a higher coupon, and there is also credit risk that's affecting their price. So they're generally a little bit less sensitive to rate rise compared to government bonds, but they are still subjected to it, especially for the higher quality corporate bonds like investment grade. They pay less coupon than higher yield sector, and the credit risk is a lesser component of the total pricing of the bond. So it will also get affected as well. But we see there are some bright spots on the right-hand side. Actually, for convertibles, for example, with embedded options of converting to equity, they actually can potentially benefit from the volatility in equity price and still record positive performance even in a rising rate environment. And also even for US high yield, as we saw, it was the best performing sector in 2021. As if the economy is still healthy and it's still paying a good amount of coupon and not defaulting that much, then the coupon can potentially compensate for the decline in price and therefore still offering a relatively better level of return compared to other segments. And lastly, maybe just to mention the current environment on high yield sector, both in the US as well as in China, as a lot of people are concerned about. And we can see actually in the US, the default rate has declined after the spike during the COVID episode, and it's now below the historical high. And this is supported by a pretty strong economic backdrop, as what Sam has mentioned. And also the recovery rate is higher. It's better than the historical high. And a lot of it is probably already priced in by the price because the spread actually has also tightened quite a lot. And we will see that the valuation across different fixed income sectors, maybe we can just move on to the next slide, is generally quite tight, especially for US high yield. Actually, its valuation is it's at historical tight, the historically tightest level, whereas there are still some other rooms for other asset classes across fixed income markets. So it's important to diversify, not just to focus on the best performing sector, but to diversify across different sectors and gain value, therefore, in a forward-looking way. And lastly, just want to mention on the China property market, as I think this has been on the news headlines, especially for us who are based in Asia. So just a brief look at where we are now. So we can see that the current valuation of the market, based on it, a significant part of the China property bonds are trading at very distressed level, implying a very high default rate that the market is pricing in for the sector. And such extreme valuation actually has pushed the yield differential between Asian high yield and US high yield to be about 3%. So the yield on Asian high yield sector is 9.6%, which is extremely high. So the question is where we are heading towards, right? And the answer is, of course, no one knows. But one key thing to look out for is the direction of policy development and whether China will continue and come back and provide more support to the sector. And we have seen some initial improvements towards the end of Q4 as China reduced the reserve ratio, and there were also new issuance by high quality developers, both onshore and offshore, and there was a slight normalization of mortgage release and a temporary postponement of new property taxes. But I think the investors and the market are still waiting for more developments to materialize and a clearer change in policy direction, as well as for the policy change to actually materialize and be reflected in the sector's liquidity condition. So in the near term, there might still be quite a bit of volatility as the funding environment is still relatively tight, but we need to closely watch the environment and see how that develops. Yeah. Sam, I think you're muted, but I see that you're talking.
Yeah, sorry. So great. So we're gonna go to Q&A. That's the end of the presentation, and so thank you so much, everybody. The first question we have is the first time in the history that China goes against the direction of Fed interest rate, low versus highs. Now, good time to invest in China. Okay, there's several reasons why you want to invest, and again, you have to differentiate between equities and fixed income. I think maybe you are asking about equities, which is what most people do in terms of trying to time the market. The problem with China I have personally, especially when it comes to government policy driven investment thesis, is that the transparency and the predictability is probably the lowest of any country. So if you're thinking about making investment decision based on monetary policy, especially, which is what you've asked here, with the US, there's a high level of transparency. We get the Fed meetings, we know when they're going to meet ahead of time. They publish their meeting notes afterwards. They do a public press announcement telling you exactly what they discussed. They take action, and it's transparently, telegraphed to the market in advance, and the market responds in a very efficient manner. So the policy and why and what is very, very transparent. So basing your investment decision on a transparent, relatively transparent policy that is based on a process and a system is much easier to do than to do so with a China PBOC monetary policy, which is not as transparent, let's just say. So we don't know, when they will cut rates. We don't know why they cut rates, and we don't know whether it's part of a fiscal, action. So the lack of transparency is, always going to be the problem with Chinese government policy. I'm not saying that the policy is wrong. They've shown to be amazing managers of their economy and their economic cycles, being counter-cyclical very effectively in preventing recession. The extended period of growth that Chinese economy has, achieved is tremendous. And so it's not a problem for China because their growth is sustained. And to be honest, the mechanism in transferring liquidity through direct interest rate policy is much weaker in China as well. So in the US, the Fed is the king because it affects monetary policy directly at the short end. It could affect balance sheets. It could buy treasuries. In China, because they've had the whole arsenal of direct counter intervention of intervening in the markets or in interest rates. Interest rates itself is not a very effective or an efficient tool in China. So I wouldn't use interest rates as the only proxy like we do in the US. I would use in China the government's overall kind of policy directive and direction, what the guidance is, and we can see that they are taking action with the property sector. You can clearly see that they want that sector to deflate, but they wanted to do it in an orderly manner. So after the initial shock, I think that they are already cutting rates, pumping some more fiscal money into targeted areas within property. They want the good companies to survive and maybe the poorer companies to maybe slowly disappear or be taken over. They want it orderly, but they do want an adjustment. That's very clear. For the rest of the economy, you can clearly see that the government wants a stable growth scenario this year. So I wouldn't be bearish China, especially in fixed income where we saw a massive carnage of certain sectors. Avoid the riskiest parts of it, but overall credit, I think for China should be okay. And there's up to now, the big concern is there any systemic risk in China? For now, there are no signs that there's any major systemic crisis in China at the moment. So unless that shows in a meaningful way, I think China medium long term looks okay. But that inflection point of when will it turn back up, who knows? And only the government will know. And we'll have to watch the government very closely and the policy. But I don't think anyone can be able to say that we can predict that with any high level of confidence. What's your view on inflation for 2022? Do you think inflation will peak in 2Q and taper down by the end of 2022 to maybe 3-4%? Very specific numbers. I'm going to focus just on the US and US inflation because it is the most important. And it's also a barometer for global inflation. What's interesting is that there are two factors, I think. One is base effect, right? March 2020, COVID hit. And then obviously, we had deflationary impact. So from April, we saw inflation come off very sharply, and then all the way up to June, July before it started slowly picking up. So in January of 2021, early periods, we went above 2%, but it wasn't until like April, May, when the base effect, started falling, that we saw the 4 and 5% inflation rates. But what's interesting is that in the second half of the year, and the fourth quarter in particular, when the base effect was becoming higher, this is why many people thought this inflation was going to be transitory. They expected inflation to come off. And so that's why the 7% print in December was a surprise, because even with a lower base effect, inflation surprised on the upside. And that is all to do with the supply chain bottlenecks, the cost push inflation that occurred. And that's why when we prepared the slides, we focused on all of that. The base effect, which is why I think you're asking these questions, is going to start tapering off maybe from April, May into June, July. And then all the way to the end of the year, the base effect will be much higher. So I don't think we'll be growing, 5% on top of a 7% print in December of 2021. But we're probably going to see elevated inflation all the way up to the first half because of not only base effect, but also the supply side constraints that exist in the market. There's a lot of questions about growth stocks being down, US equity valuations. And I think that it's just, as I explained, I think it's a natural consequence of those sectors outperforming so tremendously. Secondly, valuation being so high. And thirdly, inflation and interest rates being such a shock to that particular sector. But there are other sectors within the equity markets that I think will take leadership, whether it's value or quality or certain sectors. So it's important to watch out for that. I just picked up a question on any chance of dimensional PIMCO funds. And so, yeah, PIMCO is not going to be entering CPF, but dimensional, we think we'll be able to enter CPF from the second quarter. We have exciting new products and solutions that will be coming out very soon. Any questions you see, Lynn, that you want to answer?
Yeah, I saw a few questions on Cashsmart, and I think it'll probably be a good platform to clarify. Although I would highly recommend anyone who still have questions on Cashsmart to go and take a look at our Insights article that is super comprehensive and super in-depth. But I think I just want to clarify here because I saw a question on can Endowus justify on Cashsmart Ultra? Okay, can Endowus justify that Cashsmart Ultra can achieve the projected 1.9 to 2.1% yield? I still couldn't understand why my returns from Ultra is not even near the projected return. Yeah, okay. So I think there are a few things here. The first is a correct understanding of the projected yield of 1.9 to 2.1%. So this is actually based on the yield of the underlying investments if those investments are held to maturity by the fund. However, bonds are subjected to mark-to-market volatility as the rate and credit risk moves around. And this is what has largely affected Ultra's performance as it has some exposure to Asia. And when the yield, and in the past few months, we saw that even the shorter end of the yield has raised. And we mentioned the negative relationship between yield and price, right? When yield increases, actually the price comes off. So a yield increase is actually beneficial for the forward-looking expected return of a bond because, when the price gets lower, actually the future potential increases. And this is why you're seeing that the projected yield still remains at 1.9 to 2.1%, while it feels a little bit out of sync that actually I'm seeing the price coming down, right? But that's exactly because of this relationship. But but once the bond matures and if it doesn't default, then this will pull back the performance. And the performance, if you hold it for a long enough period of time, above, then it will probably get back to close to 1.9 to 2.1% the projected yield. But the question is, no one knows how the situation would pan out looking forward.
If I can
Yeah,
add a little bit on that, I think that, the only way to show projected yield, to be transparent and fair, is to show the yield to maturity. So
yeah.
that's the industry practice. It's the standard industry practice to show the yield to maturity of the overall portfolio or the underlying fund. So the data is provided to us by the fund manager, and we publish it transparently. We actually get it updated on a much more regular basis than others, so that we can update it on a regular basis to our clients. But it's always a guidance, because the secure and short end, there's not much volatility, so it does what it's supposed to do. So if you look at our Cashsmart Secure, what our yield projection is, uh, basically the yield is a yield to maturity. So for the short end, for Cashsmart Secure, where we hold it for 60, the maturity is 60 days. Then within 60 days, you get back your money and your coupon, and so yield is realized. For enhanced, it's about, just under 1 year. Then, normally it will take, there's some volatility, but normally it will stay within that range. For ultra, it's 1.6 to 1.8, depending on which funds at any point in time. So it requires a longer period of time. Now, when we talk about price movements, that's because bonds are traded in public markets and is priced on a daily basis. The bonds itself, there's no change in the value, like the underlying borrowing that you've given, and the fact that you're going to get that money back with the coupon when it matures. So if you hold it to maturity, you will realize the yield. That's fixed income. That's the difference with equities. With equities, you buy something and the company performs badly, it can continue to fall forever and go to zero or go bankrupt. But fixed income, as long as you don't go bankrupt, as long as they don't default, and we haven't had a single default in our portfolios, you will get the money that you lent plus the interest. So as long as you hold it to maturity, then you will get your return back, and that's a cycle, constant cycle, that will occur. So it's important to understand how fixed income works differently from equities, how Cashsmart is, secure is very, very short, enhanced is slightly longer, and ultra is slightly longer than that, but still shorter than 100% fixed income, where, the duration goes up to like 5, 7, 10 years. So it's a very ultra short duration. And so if you hold it, then you should be able to realize the returns. Last year, remember, Cashsmart Ultra gave you 2.85%, even though we guided for 2%. 2.2%, it did much better because of the price movement. But if you held to maturity over 2-year period, it was, largely in line with the 1.92% to 2.1% that we expect. So it's a time duration issue. We understand the pain point. A lot of our employees and ourselves, we all have money in Cashsmart Ultra. But I think it's important for you to understand what the risk of ultra is. And a lot of people focus on the 3 to 6 months, or 3 months, or 1 month, or for enhanced. But that duration is one important factor, but it's not the only factor. And we should think about, what is the money used for? Is this money that I really, really cannot lose a single cent at any point in time, because I might have to pull it? Then it's, you shouldn't be an ultra. You should be an enhanced, which has generated 1 point something percent, and secure, which has generated 0.8% without any volatility. So you have to understand that. And there's a lot of questions about high yield, and it's exceptional that we saw this massive dislocation in Asian high yield. So global high yield did not fall as much. US high yield did not fall as much. It was just China, and it was Asia. Who could have imagined Asian high yield and China being the biggest detractor to fixed income returns last year? I don't think anybody could have predicted that. And that's the nature of financial markets and fixed income. March 2020 was the last time this happened, as I showed in the slides. And March 2020, who could have predicted COVID? But if you had held on to your fixed income, it would have recovered. 100% fixed income would have recovered, taken a little bit longer. Your short duration stuff would have recovered a little bit faster. But there is this unprecedented nature of China and Asia high yield, impacting markets. Some of it is related to fund managers trading in the wrong way. Some of it is related to beta market performance. Some of it is just just bad timing. But all of this is unprecedented and something that we could not have predicted. So we feel your pain, but for Cashsmart Ultra, I think it's important to reassess when you need the money and what you need it for, and what is the appetite of risk that I'm willing to take. Don't just go for the highest yield of 2%. Be happy with 1.5 because it's still significantly better than any bank deposit that can generate with Cashsmart Enhanced. Make sure that you're in the right, or even Cashsmart Secure at 0.7 or 0.8%. But once again, as Yulin said, if you could please, we wanted to do a separate seminar or webinar on Cashsmart to address these questions. We just couldn't fit it into the schedule. But we published, as a result, a much more detailed note on our website, the Learn page, Endowus Insights. We have a really long, detailed publication on Cashsmart Ultra as a monthly update. And this time we changed and revamped the whole structure. We tried to give a lot more information and transparency, and give a lot more understanding of what it is, and addressing actual direct questions from clients. So please read that and reach out to us if you have any further questions. And if we can schedule a Cashsmart separate webinar, we'll definitely do that as soon as possible. January is turning out to be another tough month for Cashsmart, but hang in there, and we hope that the markets will move in our favor in the near term. With that, we've run way over our time again, guys. But if there's any additional questions, please reach out to us. Yulin, any last questions that we desperately need to answer before we go?
No, I think a lot of questions are actually addressed during the webinar. So if you came late, maybe it's worthwhile just going back to different points in the webinar and see content of your interest and get your questions answered.
And I can't share the chart, but it's from Bloomberg that we use, the ARK ETF and the Bitcoin correlation chart. Somebody asked for it. Please reach out to support@endowus.com and we'll share that with you. But you can also just rewind. This is on YouTube, Facebook, and LinkedIn live. But on YouTube, the Endowus channel, it will be available. So you can actually just rewind to that section, and you can always just watch that and screen capture that. So thank you for joining us. On Wednesday, day after tomorrow, we have the income portfolio launch. So please join us for that, and we'll share a lot more information. If you have Q&A, we can follow up with the Q&A on Wednesday as well. So please join us for that. Thank you so much for joining us today. Have a wonderful evening. If we don't see you on Wednesday, then Gong Xi Fa Chai. Happy Chinese New Year for you, and hope you have a wonderful time with loved ones and family as well next week. But if you can join us on Wednesday, we'll see you then.
Yeah.
Yulin, bye.
Thank you and bye. See you on Wednesday.